So I've run through this Excel sheet on compounding before in another video, but I wanted to run through it again because I wanted to explain why would anybody get involved in dividends. Like if 5% is considered a good safe dividend, why would you put your money into something that makes 5% a year when you could put it into like any reasonably safe trade and make 10% in a day? You know, you could make a year's worth of dividends if one risk that you take pays off. So I think it would be important to lay out why people consider dividends to be a safe way to preserve your wealth. Because you could make, like, a good way of putting it would be if you won the lottery or if you came into a lot of money and then started spending it. You know, if you don't buy things that will produce more money, the money will disappear. It will eventually hit zero. You know, if you buy a house, you have a good investment, which you can later sell. But why people get into dividends is because it's passive, which means you don't have to look at it. You could invest in something which is called an ETF, an exchange traded fund, and that is basically a fund that's run by professionals who will do all the trading for you. They'll do all the dividends and they'll log everything like that for you. And then you just receive a quarterly dividend, so 4 times a year, from this fund. And it will be diversified. It could be across 500 stocks, and if one of them is underperforming, then they will sell it and replace it with the next best one in line. It's totally passive. You don't have to touch it. But the reason why a lot of people do it is to reinvest the dividends. So if you won the lottery, say, and you won €1 million, what would happen is if you invested in something that earns 5% a year, now this is done with 1,000, but to kind of put it into perspective a bit, if you came into $1 million very quickly and instead of saying I'm going to go on loads of holidays and I'm going to spend loads, I'm going to buy loads of cars and get a mansion or whatever, if you put that away and you earn 5% on it, you would earn 50 grand in dividends every year for doing absolutely nothing. The only thing you would have to do would be pay your taxes on it at the end of the year. So taking risks is what builds wealth, and dividends is what sustains it. Because the value of all money decreases over time. So if you have $1 million in cash, in 30 years' time, that won't have $1 million worth of purchasing power anymore. So the original amount that you put in, that could go up or down in value depending on the share price, but you'll receive the dividends. And when you reinvest them, if you start with 1,000, you get 50 in dividends. At the end of the year, you'll have 1,050 in actual cash. So the 1,000 you put in, which could have gone up or down in value, and then €50 in dividends in cash. So you start the next year with 1,050, and then you earn 5% of that, which is 1,102. Then you start the next year with that. You earn 5% of the 1,102, which gives you 1,157. And this 5% that you earn gets bigger and bigger and bigger and bigger as the years go on. So you can see the difference between in the beginning, it takes quite a lot of years, 14 years to go from 1,000 to 2, which is why people don't do this with a small amount of money. And then at the end, the difference between 40 years and 50 years, it goes from 7 grand to 11.5 grand in the space of 10 years. So the longer you leave it to compound, the faster it grows. But it takes a long time. So you can see here with 5 grand invested, you earn €250 per year in dividends. At the end, you have 5,250. You start the next year with that, you earn 5% of that, which is €262, and you end up with 5,500. So that's what dividend compounding is. It's what Albert Einstein called the eighth wonder of the world. It's where you earn interest on your interest. And theoretically, the more money you put in, the faster it will grow. So that's the reason why most people do it. It's not really something for building wealth. It's more for putting money away and saying, I don't ever want to have to worry about that again. And it will retain its value. As long as you pick stocks, like dividend paying stocks that are not hopeless. There's so many companies that will definitely be around in the next 50 years and doing quite well. Starbucks, Coca-Cola, PepsiCo, Johnson & Johnson, Realty Income. There's loads. The best of the best are what's called the dividend aristocrats. That's these. So they would need a huge market cap and decades of consistent dividend paying. So anybody who's not sure about dividend investing, these would be the ones to go for. You can look up the list of them, and if you're outside of the USA, you can look up the Noble 30, which are the European dividend aristocrats. But I'll do a quick rundown of some of the basic terms in case anybody's interested. So when you receive a dividend, it's a distribution of earnings, which is like a thank you for holding on to the stock. So it can be in cash or it can be more shares of the company, which is this, a dividend reinvestment plan. Some companies will do it automatically, like you go onto their website and you say, I want to do the dividend reinvestment, and then you don't have to do anything. So when you receive a dividend, instead of it becoming cash, which you can then take out and spend, you put the dividend back into the same company and the next dividend payment gets bigger. It's like rolling a snowball down a hill. It just gets bigger and bigger, and the larger it gets, the more snow it can collect. Then it gets even larger, it can collect even more snow. So here, outstanding shares is just the amount of shares that can be publicly traded. The EPS, if you see it anywhere, let's pick Amazon for example. That's here. EPS is earnings per share. That's just basically how much money the company makes per share that exists. 61 is very good. Now 1.75 trillion market cap. And the market cap itself, that's decided by the stock market. So once a company goes public and allows the public to trade in its shares, that's when this market cap, like it could, say if you look at GameStop for example, GameStop was trading like $5 a share and then it went up to 400 and the market cap went through the roof. It went from, I think it was hundreds of millions of market cap to billions, like in the space of a week. So this is decided by the stock market. But it's the value of the company basically, depending on the opinion of the overall stock market. Your PE ratio is your price to earnings ratio. So this is how you value a company by comparing its current share price to its current earnings per share. So a high price to earnings ratio means that the company could either be overvalued or analysts believe that the stock is going to be valued much higher in the future. So if an PE ratio is not given, it means that there's no earnings, so they're losing money. Dividend frequency is simply how often the dividend is paid, and depending on the stock, it can be every month, every quarter, 4 times a year, semi-annually, which is twice a year, and annually, so just the once. And if you see on any websites, if it says interim payment, that's the halfway of semi-annually, and then the final is the second one. So if it just pays an annual dividend, it will be called a final dividend. And this is completely up to the company. So they can pay as often as they want, they can declare a dividend whenever they want, but they can also stop or decrease a dividend whenever they want. So that's why these blue chip stocks are so safe for dividends, is because they want to remain blue chip stocks. It's like joining a VIP club. You want to stay in there for as long as possible. And all they have to do is keep their dividends low enough, but also reasonable. So lower than 5% is generally considered the safest because it's only 5% of their 5% of their earnings are paid out. So a special or a bonus dividend is a once-off dividend, but they can happen multiple times a year. So it's an unannounced, it's like a treat. So if a company did very well and it wants to hand out some of its earnings to the shareholders, they'll issue a bonus or a special dividend. The dividend yield is how much you make based on where you got in on the stock, so your position. So Amazon doesn't pay a dividend, but in theory, if you bought in down here and it was $3,000 a share, let's say they paid $300 per dividend payment. Then you bought in here, they paid $300, which is outrageous. Then no company would ever do that. But as the stock price increases over time, generally a good dividend paying company will increase its dividends over time. So you could have bought in down here, and then in a decade of holding, not only has what you've put in increased in value a lot, but the amount of dividends you receive also has increased a lot, which is something they call yield on cost. So it's the yield you're getting compared to the amount of money you put in. And this is another one, yield traps. So there's some companies that will have a massive dividend yield. So let's say something like 15%, but it'll be a consistent 15%. You know, it's not just a freak occurrence where you can get some really nice positions and have a great dividend yield and hold it for life. But a dividend yield trap is a company that, whether or not they do it intentionally, I don't know, but it's when you buy into a stock because it has a fantastic yield, and it will still take you like 10 years to get your money back, but the stock either decreases in value or doesn't grow at all over time. So these ones are quite dangerous. The dividend payout ratio is the percentage of the company's earnings that it pays out as a dividend. So if they pay nothing, like Amazon, it means that they're using all that money to grow the company. So if you like growth, then that's what to aim for. If you're in dividends though, about 30 to 50% is the sweet spot. They keep enough to grow, but they also give out enough for it to be worthwhile putting your money in. A REIT is a real estate investment trust, and they have to pay up to, or I think at least 90% of their earnings out as a dividend to get great tax benefits. And there'll be a lot of companies that don't pay at all. But REITs are known for their frequency and their yield because they have to pay it out to get a great tax break. A lot of real estate investment trusts will be the ones that pay every month. So the revenue, there is it, revenue. 386 billion for Amazon. The revenue is the income of the company when it's operating normally. So this is the gross income, which is the total income that all the costs and expenses are then subtracted from to get the net income. So revenue can also be known as sales if you're reading an income statement, but the difference between revenue and profit is that revenue is before expenses and costs are taken out. This is something you might also see as well. It's called beta. Yeah, so a beta of 1.16 for Amazon. This is the volatility of the stock compared to the rest of the market. So a beta above 1 means the stock swings more than the general market. So we know from this that Amazon swings more than the general market. The higher the beta, the higher the risk, but also the higher the potential reward from trading the stock. So I went over dividend kings and aristocrats briefly, but if you want to get into dividends, they would be a great place to start. Another thing I did in the beginning was I would watch loads of different dividend stocks YouTubers, and then write a list of the ones that they all had in common. That's generally a safe way to do it. And there'll be companies that you recognize, big ones that you might not realize how much product they actually have. Like PepsiCo. I thought that, like, Pepsi, it's nice and everything, but I don't see how it's such a big company. And then when I looked into it, they have loads of products like Mountain Dew and Doritos. They're both owned by the Pepsi company. I hadn't a clue. But I'll leave all that fun stuff to you. The research is actually, it sounds like work, but it's real fun when you start learning just how vast some of these companies are. Now, the withholding tax. So this is the tax that's taken out before you receive the dividend. But bear in mind, you still have to pay tax on your total received income at the end of the year. So the reason they keep this is because instead of them paying it out to you and then saying, oh, well, we need 15% of that dividend back for tax reasons, they just take it beforehand. It makes it way easier. But bear in mind, although you pay withholding tax, you also have to pay your tax at the end of the year. It's not, having a withholding tax doesn't mean that you don't have to pay for that earning. Now, a return of capital, that has no withholding tax. I don't think I did. I received a return of capital in the last few payments. I'll go into history. So when you receive an ordinary dividend, depending on the country, you could have like a 15% withholding tax. UK dividend stocks have no withholding tax. So here, Alstom, this is a French dividend stock, 27% withholding tax. That's pretty high. Wells Fargo is 15%. I'll try to find a return of capital. There. So this is a return of capital, no withholding tax, which means they didn't keep any of it. And this amount, the 3 cents that I received from it, this is not income. This is tax-free return of the money that you put in. So it's important to separate your dividend payments and your returns of capital, because dividend payments are taxed as income at the end of the year. But a return of capital, say you have €100 in a stock and you get a €1 return of capital. That means you still have a €100 position in the stock, but you've been given back €1 tax-free, which you can then send off to have its own little dividend adventure and earn its own pennies. But you don't pay tax on that when you receive it. The only time you start paying tax on that is when you've received the full €100 back that you put in. Because then if you get a return of capital on that, it's income. It's more money than you ever put in. But it would take years for you to earn the full amount. Like, I think I have like €3 in Invesco, and I just got a 3 cent return of capital. The ex-dividend date. This is the deadline for when you're eligible to receive the next dividend. So generally people buy in like 2 days before. They wait for the ex-dividend date to pass, and then they're eligible for the next dividend. And they'll be like, if a stock pays every quarter, they could have an ex-dividend date like a month or 2 months, even 3 months before the payment date. But as soon as you have bought it and this ex-dividend date passes, you can sell the stock and you'll still receive the next dividend. A lot of people do that. They try to time the ex-dividend dates. The only thing you have to keep in mind with that, though, is the stock generally drops by the price of the dividend, or by the amount of the dividend when it's issued. So you will notice that a stock might drop like a few percent in a day, but then if people put their dividends back in, they're doing it at a discount. So it kind of encourages reinvestment. And the last bit for this video is the declaration date, which is simply when they declare the dividend. So they'll declare it first, then they'll have a deadline date, which is the ex-dividend date, and then there's the payment date. But you don't have to wait to receive the dividend to sell the stock. You can do it as soon as you've crossed this deadline. But just to be safe, like for time zones and things like that, I would give it 2 days on either side. So 2 days before the deadline and maybe sell it 2 days after. Even 1 day, but it's up to you. I'm personally just going to keep buying loads of them and holding loads of them, so I don't have to worry about these. Yeah, but I hope this clarifies things a little bit, because it's easy. Like, I started this about a year ago, and it's easy to kind of forget the very basics because you keep hearing the same terms and the same things being discussed over and over and over again in the same community, so you get used to how it works. But in the beginning, I hadn't a clue, and I was real excited about it, and then I'd put like €10 in a stock and get like a few cent, like maybe 10 cent over a year. Yeah, I've gotten €72 in dividends since I started, but from selling stocks, gotten 2,000. So that's the difference. The only reason I'm doing this with all the dividends now is because I want to see what happens, this compounding cycle. I want to see what happens if this €50 is given in tiny pieces every day, so that instead of at the end of the year putting the €50 in and then earning a bit more at the end of that year, I want to see what happens when it's tiny little bits, so that every next dividend payment is just that little bit bigger. But it may not work, and it may work, but we'll see. Well, thanks for sticking around, and I hope this is helpful, because it can be very confusing in the beginning. But let me know what you think.